Welcome to the FX Trading Sensei. In this video, we are going to delve into the topic of market structure, a very key topic for all traders to understand in order to place trades successfully. Listen up. Welcome to the Forex Trading Sensei, and we are at Lesson 2, Part 3, Understanding Market Structure. And when I say market structure, I'm not referring to the participants in the market and how they're related or interrelated. I'm referring to the price chart from a technical standpoint to understand how this particular market or instrument that you're trading is behaving or performing. So what we're looking at here is an Aussie USD chart, and it's a 15-minute chart, which you can see here. So we're going to analyze this using some of the tools that we've already looked at in Part 1 and Part 2, and as well as the candlesticks. So what we're seeing here, we had a very nice sell-off on price. Price turned at a support level and started going higher. So in order to place a trade, we need to understand how is price behaving. So we need to begin to compile the information that we are getting from price action based on our technical analysis. And market structure is very key, because if you're not careful, you could misinterpret even what your indicators are telling you and end up in a losing trade. So the first thing I want to go back to that we covered in a previous lesson very briefly is the idea of a price swing. Because you need to understand that price moves similar to a pendulum or a clock, where you have price moving in one direction and changing and going in another. So as it's stair-stepping, you can see here, price does not go up in a straight line, and it does not come down in a straight line. It will go up, come back down, go up, come back down, go up, come back down. So market structure will help you to understand where price is in that particular flow and in that cycle of movement, so that you can anticipate your next course of action. So here we have price. This will be a support level, which I'm going to mark off with a horizontal line. So this represents a support level. We can see that price did pop below it and came back and found support right here. In addition, it gave us a very bullish candlestick pattern, which should have clued us in that maybe this price is ready to go up. So it does make a sharp move up and actually takes out these highs at this point. So that is a good sign for a buyer or a bull, someone who's thinking that price may go higher and they need to look for a buy opportunity. However, we still have this high that needs to be cleared to give us some credibility to this idea that we have that price may be going higher. So we watch and we see what happens, and then price retraces and comes right back to another level of support, but it does not come as low as this level. So this is a new support level. You can see it stayed here for almost an hour. Since this is a 15-minute chart, each candlestick would represent 1 hour of time. So the price consolidated for an hour of time before starting to move up again. So what should be interesting, or what should be something that's noteworthy for a trader, is to see price break this particular level here. We certainly want to see it clear this, because this can actually be a support zone. And we don't want to see price just flounder in this area. We want to see it break through. This actually would have been resistance in the past. So we need to make sure that when price gets back here, it actually breaks through it. Because remember, if you're thinking of an uptrend, you're looking for higher highs and higher lows. So in order for this to start giving us that information, we need to see a higher high than this one here. And we finally get it when price breaks through on this candle. Let me just put a line here just to mark this one off. So it actually broke through this particular level. This candle pierced it and came right back. So it's important that when you're looking at candlesticks to make decisions like this, you need to be sure that you let that deciding candle close and then look for confirmation after that. You don't want to jump the gun. You don't want to be hasty, because impatience in this business will really cost you. So this candle breaks through this level of resistance. So what do we have here? Because of this action, we now have something that's developed that's very, very supporting of our idea, very supportive of our idea. This is a swing low. And remember, we covered swings in a previous video. So if you have not watched it, please go back and view the previous video where we discussed swings. So this would be a swing low. And this became a swing low when price made a new high. So this is a swing low. And I will just make the text larger for those of you who may be on a mobile device. This way you can see it more clearly. So this is a swing low, this point here, because this is the lowest point before the price turns. So our swing low would be this point, the low of this red candle here. So price went up and actually cleared. So the minute this made a new high, then this became an official swing low. And it went up to this high, the highest point of this candlestick. So this high now becomes a swing high. So we're using candlesticks now to map out our market structure. So this would be a swing high. So once this swing high has been completed, notice the price comes down. So the swing goes from here to here, and then it turns, the price moves to form a new swing, which is this move. So this now is a candlestick low because we have a long wick under this body. So this is a candlestick low, but this candlestick will not become, this will not become a swing low until price breaks this high. So we can clearly see that the price did go higher from here to here, made a new high because this candlestick closed above this high. So we have a new swing high formed right there. And we also have a new swing low formed. So why is it important to mark out these swing highs and swing lows? Well, first of all, if you're using that Fibonacci tool, you need to be able to identify swing highs and swing lows. And that is very crucial when you're applying those tools. The next thing is when you're drawing a trend line. When you're drawing a trend line, in this case, we have an upward move, and you're drawing an upward trend line, you want to connect to swing lows. That's very important. If you're drawing your trend lines, you need to be mindful of where your swing lows are, because you don't want to draw your trend line through the price action like this. You want to connect swing lows. And at this point, once you've connected the swing lows, you can see that the price has been consolidating. So it's okay at that point to draw through the action because you've already gotten 2 points that are clear swing lows to draw your trend line. So what is happening now? Price is telling us that it is now breaking the trend line right here. So remember, when you're drawing your trend lines, you just need 2 points to do that. And you want to select valid swing lows or swing highs to draw your trend line. That would be the best place to start. Now let me just go back and extend this line to the very beginning. This is the beginning of the move, and I'm connecting it to this swing low and extending it. So at this point now, we have a consolidation. You can see the price is just going sideways. It's not really trending. So we have an area of resistance right through here. So I can also put a horizontal line here, and I'm going to use the bodies in particular. And you can see that we have this price point as resistance. So in order for us to have a new swing high, we need price to clear these levels, because this will become a resistance zone where we have all these wicks. So we need to make sure price closes above it. And it does here, but barely so, which means as a trader, you should be cautious. And look what happens next. So this candle would be a trick or a trap, because it barely cleared the resistance area and then showed weakness and continued lower. And market structure will help you to ascertain these points. Now let's go back to this area here. I'm just going to minimize the screen a bit just to get a picture, a better picture of the overall price action. So let us put in our resistance zone. You can see here, this candlestick, let me just pull this back to this one. This was the high that came right back down below the line. So this is a resistance zone that we're looking at here. This entire region that I have marked, let me just use a red rectangle so you can see it a little better. So I'm just going to color it a very light. So this is our resistance zone. And notice price barely pierced it. So people who are breakout traders will be looking to jump in as soon as this breaks it here. And that would not be a great idea, because you have resistance and the price has barely closed above it. So you would certainly need to be patient and wait, especially when you see that price broke the trend line here and you're seeing a bearish candlestick here. So all of this is telling you you are in an area of potential weakness and you need to be mindful and careful about that. And what happens? Price turns and eventually goes lower right to the next support. See, it came right back to this line and found support here. From that place is where it started going higher and broke through with a strong candle, came back to test that area as support before going to the next level. So remember, when you're looking at market structure, price moves in levels or off of support and resistance. So support and resistance are like stepping stones. And we have those videos regarding support and resistance in lesson 2, so make sure you take a look at those. So let's look at the price action we have coming down here. Now we have price, it had been going up nicely here, and it ran into a little problem. You can see that it started to give us some bearish indications. Now, if you look to the left, you will see this was a definite area of resistance right through here. Every time price got in to this level or in this region, there was weakness. And the price kept hitting this level as a ceiling. Even had a very strong volatile candle that could not hold, and price came back down. So later on, price came back again to that same level, and notice what has happened. Weakness. So this candle at one point would have been green and would have baited a lot of traders into this to buy it. only to see it form a bearish candlestick pattern and drop. So be very careful when you see these resistance levels where price gets to those levels, because it is a sign that you need to be very cautious, because that is where you can be tricked. Price came back up again to hit this and could not hold it, and then went down. So this region was actually a good place to consider looking for a short or a sell opportunity. So let us mark out now this region here, where we have another level of resistance from these candlesticks in the past that's become support here. So when price came down the first time, it bounced right off of this with a bullish candlestick pattern, went up, hit this level, and came right through it with a very strong bearish candlestick. Notice it tried to go back to test it before going lower. So in this case, we have, this would be a swing high, a swing low. This would be another swing high, and price is coming down. So once price, this is the reverse of what we just did. So once price breaks this low right here, once price breaks this low here, this becomes a high, a confirmed swing high that's lower than this one. Remember, in a downtrend, we need to see lower highs, lower swing highs, lower swing lows. So the fact that this price, this high, is lower than this one, and price made a new low here, this became an official swing. Let me just mark it in. This became an official swing high for the downtrend. And of course, once this broke, we had an official low, a new low that was broken, that was made. Here would be a swing high. This would be a lower swing high. So we have just the opposite of what we see here. This is a swing high. This is a lower swing high. So let me just edit this one to say a lower swing high, because we're actually seeing the reverse of what we saw before. And this, of course, would be a higher swing low. So let me just mark that in, just for clarity's sake. So this would be a higher swing low. And of course, we have swing highs and then higher swing highs. So this would be a swing high. This would be a swing low. So we can mark that in. And this became an official swing low when price broke here. So it's very important when you're looking at a chart to make a trading decision, don't just focus on your indicators. The indicators will just tell you when you have a likely turn in the price. That's really what they're telling you. If you're using the RSI, for example, the overbought, oversold will give you turning points, possible turning points. But it will not confirm whether it's turning here or turning here or turning here. That is the discretion that you have to bring to your charts as a trader. And if you don't do it, you will get false signals from your indicators. In fact, they would be good signals, but at the bad time or the wrong time. And if you just trade exclusively from that information, you will be misguided. So you have to be very, very careful on how you use indicators and how you combine the messages that your trading tools are giving you. Because most of the things that are available on your platform have their validity, and they have a purpose. You just have to understand how they're designed to work and to know how to apply them and how to extract the information that you need as the trader to make your trading decision. In our next lesson, we'll be getting into lesson 3, which will be a very crucial one. We'll be discussing some things about risk. Make sure you subscribe so you can watch that video and that series of videos. Risk is very important. It's about the only thing you really have control of in the market. So you want to be sure that you understand yourself, understand risk, and the reasons why you need to handle it. So until our next video, which will be lesson 3, part 1, do take care and have a great day. Trade well.